Well, we have an exciting guest tonight.
Yes, we do.
have the CEO of Broadway Partners and Waypoint Residential, who comes to us from Connecticut and New York, Scott Lawler. Scott, thank you for being on our show. Welcome.
Thanks for having me.
Scott, welcome.
Thank you.
So what an exciting time. Tell us about your history in the real estate market. It's been a wild ride.
Well, yes, it's been a wild ride the last decade, and we're kind of onto some new challenges now. But, you know, the last decade has experienced probably a more severe roller coaster than real estate's ever experienced before. And from about '02 to, well, maybe '03 or so to '07, commercial property values in the United States approximately doubled, and then gave it back in a year.
Wow.
So that made for some real interesting times in the acquisition process, and then sort of playing through that cyclical difficulty.
And what do you think the cause of that one-year give back was? I mean, do you see any particular drivers that you really felt pulled the legs out from
Well,
the stool?
there were a couple of triggering events, and then sort of a cascade effect from there. But real estate sort of, I would say, hit the brakes, if you will, but didn't collapse in about the middle of '07 when the wind sort of started shifting a little bit, and about summer of '07 there were some negative headlines, and then into the fall of '07 it became clear we were into a different stage. But real estate didn't really fall off a cliff at that point. It kind of flatlined. Rents stopped going up, values stopped going up really uniformly across the property types and geography. And then, of course, in September of '08, when Lehman filed and a bunch of other, really there were 7 or 8 historic events within a 3-week window. They were very difficult to keep up with almost. But just about from that moment in time through the subsequent, call it 3 to 6 months, real estate lost probably more value than it did in the 3 to 4 years of the early '90s, which was the 100-year flood before this 100-year flood. And so the financial market crisis triggered an economic decline, which we're all familiar with, and that economic decline really pulled the rug out from under real estate because rents collapsed. So what you had is declining revenue streams via the rent fall off. At the same time, cap rates, or how we value those income streams, widened, and so it was sort of a double, took a double hit there, and liquidity completely dried up and so forth, and all those things that happen in a real estate crash on an accelerated basis and a severe basis from basically Lehman weekend through the subsequent 6 to 9 months.
Now, leading up to that, in your experience being in real estate as long as you have, did the buyers or the types of deals that were being done through 04, 5, 6, 7 leading up to that change? Where, for example, I know on the residential side, I'm talking about homes, not multi-unit facilities. You know, people were borrowing more and more than normal. You know, there used to be a rule 80%, and then, you know, some people always would put more down in cash, and there was equity in the property. You know, and at the end, there was no equity in any of these residential properties. Did the same thing occur? Were the lenders willing to lend more and more on that, you know, appraised value as they were in the market I'm familiar with, which is just a single home?
Sure. Well, absolutely. That was a big part of it. But I think people, I think there's a broad misunderstanding about the degree to which that drove the value run up and sort of the bubble relative to other factors. So it's clear that the availability of financing, how aggressive lenders were, how cheap the financing was, drove asset pricing, right? That was absolutely a major driver. But in certain sectors anyway, for instance in our sector, in office, it's also the case that there was a real fundamental run up in rents. And so rents doubled during that run up too. And so for instance, office space in Manhattan that might have rented for $75 in the early part of the decade was renting for $175 4 or 5 years later. And so you had that in conjunction with the very aggressive financing market that drove values. So a lot of people talk about aggressive financing driving values, which is legitimate, but there was a fundamental underpinning that was there too.
I got you.
And the confluence of the two is what drove things. And of course, when the financial market crisis precipitated the economic meltdown, the rug got pulled out from under both of those things at once.
And when you mentioned about in the summer of '07, you're talking about the hedge fund industry, the collapse of some of the hedge funds?
Yeah, there were a couple of negative headlines sort of late July, and all of a sudden things felt a little bit different, but no one really realized
Yeah.
And I remember some conversations in August where people were saying, you know what, everyone's having a little panic attack. We'll all go on vacation. We'll come back after Labor Day and everything will be fine. And then, of course, it was that November when the first real negative headlines hit with some losses and CEOs getting fired and so on Wall Street.
Right.
And that's when we all realized we were into something a little bit more than all. Everyone realized then it was going to be more than, say, the 1998 situation with the ruble or something, which was a hiccup which we got through pretty quickly.
Right.
This was obviously quite a bit more.
And a lot of it, obviously, the financial services sector, the hedge funds, the brokers, I mean, they control a lot of the square footage up there. So as they're cutting back, you know, that's not good for the, you know, for the building owners as well.
Well, that was a bit of an anomaly about this crash because, you know, the rule of thumb in real estate is that the better the real estate, the more resilient. And in this instance, because of what you just said, which is absolutely true, when we officed on Park Avenue at the time, and we were literally in the center of the storm, and probably the most severe fall-offs in value in the history of real estate occurred right there on Park Avenue, some of the best
pieces,
because of what happened on the demand side, and just you know, large blocks of space that landlords considered money good for 20 more years, all of a sudden filing for bankruptcy or trying to put space on the market for sublease. And so, I mean, Park Avenue rents fell in half in, you know, a quarter or two.
Has it bottomed?
Yeah, I think it has. I mean, you have to be careful about this because obviously we have to segment by geography, by property type, and then even within that by class. Okay, but broadly speaking, you know, real estate probably hit bottom on the fundamental side, meaning the leasing of space. Most people would say mid last year. Broadly speaking, there are some exceptions. Manhattan's already demonstrated some comeback. Washington's demonstrated some comeback. We would think San Francisco's probably still bouncing along the bottom, and Boston might have a little bit more downdraft than market. But in no instance does it seem like rents are still in free fall, like vacancies are going up. That seems to have more or less normalized. You know, of course, it's always very difficult to call the absolute bottom, but we think we're within a pretty good rounding of the era of the bottom on either side in all our markets. And now we're back to the traditional rule of thumb where I would say the best space in Manhattan is actually leading the way back. And that market is tightened. I wouldn't call it a landlord's market yet, but the dynamic is 180 degrees different than, say, 9 months ago even.
So that a lot of the inventory of this vacant space has been filled, and now we're kind of getting back to some semblance of normalcy.
That's right. A lot of the vacancy has been taken, in particular the sublease space. And that's always a little bit of, it's an inefficient factor in the market because you might have a seller, if you will. So a tenant that wants to sublease his space might have different motivations than a landlord with vacancy and might be willing to take a much lower rent. And because there were such large blocks of that type of space in this recent cycle, it kind of puts the market in haywire, you know, causes the market to go a little bit haywire because what's the price of a widget?
Right.
Okay.
And you have a new venture now. Tell us about that.